This is the second learning module within your derivatives, level 1 derivatives, and we have already covered forwards and futures in the first video. We've covered swaps in the second video. We've covered options in the third video. And in this fourth video for this learning module, we're going to cover credit derivatives and forward commitments versus contingent claims. So let's get started with credit derivatives. Now this credit derivatives is a type of derivative where the underlying asset is credit. Now what do we mean by credit? So let's take a simple example. Let's say we are talking about one of the tallest buildings in the world, Burj Khalifa, and the company that has made the Burj Khalifa called Emaar, right? Now Emaar is a construction company and they need money to finance their construction business. So what they have done is they have issued bonds. They have issued bonds to get money from investors. And one of their investors is the Abu Dhabi Investment Authority, which are buying these bonds. And Emaar is selling these bonds. Now, the Abu Dhabi Investment Authority is happy because these bonds are paying a decent rate of, let's say, 5%. But they are also afraid that what if Emaar goes bankrupt? What if Emaar goes bankrupt and it defaults? Then Abu Dhabi Investment Authority will lose all the money. So what Abu Dhabi Investment Authority can do in parallel is that they can talk to a bank. Let's say they talk to Emirates NBD Bank. And Emirates NBD Bank gives them the assurance, it's like an insurance contract, that Abu Dhabi Investment Authority will pay periodic payments like you pay on an insurance premium. So Abu Dhabi Investment Authority can pay periodic payments to Emirates NBD, and Emirates NBD in exchange for those periodic payments will give them something called a credit default swap, which means that in case Emaar defaults, Emirates NBD Bank will pay the Abu Dhabi Investment Authority the due from Emaar. Now this is kind of an insurance. So the main type of credit derivative is a credit default swap, and that is the example I have given you over here. This is a contract between two parties. What are the two parties? ADIA, which is the Abu Dhabi Investment Authority in this case, and Emirates NBD. It has nothing to do with Emaar. That is just the underlying credit. This is the underlying credit. But the actual two parties are ADIA and Emirates NBD, where ADIA is the party which is the protection buyer and Emirates NBD or ENBD is the credit protection seller. Now let me demonstrate this in a clear diagram. So here is Emaar, which is the borrower, and here is the Abu Dhabi Investment Authority, which is getting the interest payments from the borrower. So Emaar has issued bonds, ADIA has bought those bonds, and they are getting the interest payments. Now ADIA is afraid that Emaar might default, so in parallel they contact Emirates NBD and they get a credit default swap for which they make periodic payments, and in return, in case Emaar defaults, then the whole payment will be made by Emirates NBD to Abu Dhabi Investment Authority. So this periodic payments is the series of cash flows that the seller is receiving, and in against to that there is a promise of compensation for the credit losses resulting from the default of a third party. Now one point I want to emphasize over here is not only that in complete default the payment is made, even if the credit quality is changing, ADIA will benefit. Now what that means is that let's say Emaar already has a credit quality of AAA, right? But then it goes from AAA to triple B. So that's naturally a bad thing, right? It's coming down in terms of its credit quality. If that happens, then there will be a mark to market gain for the Abu Dhabi Investment Authority. How that is the case and how it is measured is through something called the spread, right? And that is the credit default swap spread. It is multiplied by the amount of the total loan, the notional amount, that is it for $100 million or $500 million. And it is also multiplied by the effective duration of the credit default swap in terms of how many years are left till the loan is going to mature and be paid back. And whatever changes there are in this spread, whether it is going up or down, depending if the credit quality is improving or worsening, then Emaar is going to, Emirates NBD is going to have to adjust the profit and loss to RDA on a real time basis. So it's not only that in the event of the default that the buyer of this insurance, which is the Abu Dhabi Investment Authority, is going to benefit, it is also during the course of the life of the loan, even if the credit quality is changing. And of course, if it defaults, then definitely the protection buyer receives the total amount of money. Now again, this is very important, that is it really the total amount of money? So this formula that you see over here, which is, let me write it again for you, loss given default multiplied by notional amount. Now if they are going to receive the total amount of money, that is the notional amount, why we are multiplying it with the loss given default? So what this means is that if there is going to be a default, God forbid, let's say if Emaar is going to default, it's not necessary that the total amount of money will not be received, because there might be some collateral which is available, there might be some security deposit which is available. So after whatever recovery is possible, whatever remaining is the loss amount, that is called loss given default. So loss, maybe that is 80% or whatever, 70%, that 20% there is a security deposit, 80% will be the loss given default. That given that default has happened, what will be the loss? And if that is 80% multiplied by whatever is the actual loan amount, let's say that's 100 million. So 80 million is what Emirates NBD will have to pay to RDA, because RDA is one that got this credit default swap, which is a form of insurance, and this is done to cover the loss of the par value, which is the face value of the bond, in case the borrower is unable to pay it back, right? And of course that happens in case of bankruptcy or restructuring or failure to pay back for whatever reason that the company, the borrower, is unable to pay back. And why this is done? So that you can transfer the risk of the borrowing from one party to another, and that one party in our example is the Abu Dhabi Investment Authority, to another, which is the Emirates NBD Bank. Now next point here is the difference between forward commitments and contingent claims. So we've talked about this before as well, and I'm going to talk about it again, that let's say we want to invest in a stock, let's say we like Tesla and we want to buy Tesla stock. Now we have two options of doing that. One option is that we can buy a future or a forward of Tesla, or we can get a call option. Now, what is the difference between the two? The difference between the two is that a future or a forward is a firm commitment, which means whether we like it or not, we will have to buy this stock. And here it is a contingent claim. So let me give you two clear examples. Let's say over here we are saying that we will buy one share of Tesla for $1,000, and here we will buy one share of 10,000 one share of $1,000 if we want to. So here we have the right but no obligation to buy, and here we have an obligation to buy. Now, how does that look on a chart? So let's say this is our profit, right? And this is the price of Tesla. And this is $1,000. Now, naturally, if the price will be more than $1,000, we will be happy, because the higher it goes, right, the higher it goes, the more profit we have. So let's say it goes to $2,000. So this distance from here to here is this profit of $1,000 that we will get if the stock goes from 1,000 to 2,000, because we have a right to buy it, and over here we also have a ability to buy it. But the problem with this situation, which is the future or forward, is that this is a firm commitment, which means even if it falls down, you still have to buy it, right? You don't have an option, you have an obligation to buy. So the payoff for the forward, the payoff is that it goes up, but it also comes down in a straight line, right? There's a profit, but there is also a loss. But that is not the case with the option. That is not the case with the option, because you don't have an obligation, you have a right, but no obligation, which means you have the benefit of the upside, but you don't have the loss, because if it goes down, you don't have to buy it, right? But there is little bit loss still going to be there, and what that amount is, so this amount is basically the premium that you paid to get this right. And now let me show it to you on a nice diagram. So the difference that you see over here, this is the premium that you pay, and therefore the profit and loss of the option actually starts from negative territory. It's not starting from zero. It is starting from negative, because you've already paid some amount of money to get a right to do this. And it stays at that negative point until it crosses the price, the asset crosses the price at which you can buy it. And the payoff starts going up, and it starts pulling your profit of the option profit up. This is your option profit. And it starts pulling it up. So your upside is unlimited with the option, and your downside is limited, which is very good. But you are paying a certain premium for this. With the forward, the upside is also unlimited, but the downside is also unlimited. So as far as the upside is concerned, you can create similar exposures. Both a long forward and a call option will benefit from the increase in price, but the downside is not similar. As far as the downside is concerned, the stock price moves up, both profits are same, but when the stock price moves down, the call option provides a protection on the downside. And to get this protection, what you are paying this premium, right? And if you look at these formulas, they are actually very simple. That this is the spot price. So let's say if the spot price of Tesla goes to 2,000, and the price at which you have the future contract, the obligation to buy is 1,000. So the profit that you're going to make is the difference between the spot price at the expiration and the future price that which you got into the contract with. And as far as the option is concerned, definitely if the spot price will be below what your exercise price is, you are not going to exercise, which means it will expire at a zero value. But if it will be above your exercise price, let's say it is above and it is 2,000, then this is what you will make, 2000 minus 1000. So max means whichever is more. Naturally, either it's going to be less than your exercise price, which means you're not going to exercise your right, which means the payoff will be 0, or it will be more than this. And if it will be more than this, then whatever it is, whatever the spot price is minus the contract price, which is the exercise price, the difference between the two is your profit. But you do have to make an adjustment over here for the premium, because this is something you have already paid for. And based on this, we can draw the following conclusions: that if the difference between the spot and the exercise is greater than the premium, then the forward profit exceeds the option profit, right? Because you don't have to cover the premium in the case of a forward, right? So you're better off getting the forward because it's already in profit. But since you didn't know that from before, that's why, to be on the safe side, you went for the option. If the spot is equal to the difference between the spot and the future price is equal to the premium that you have paid, then the forward profit equals the call option profit. And if the spot price is less than the difference between the spot price and the future price is less than the call option premium, now this is a situation in which the price is low, which means your option profit will be more than your forward profit. Your forward is going to be in a loss. Now let's discuss the summary of the entire learning module. Now this learning objective is going to be there across 3 slides. In the first slide, we will talk about forward and future contracts. Then we're going to move on and talk about swaps, options, credit derivatives, and each time you will see that the topic that we are talking about is underlined. Here, forward contracts and future contracts are underlined. Now, both of them are very similar, in which two parties agree to exchange a specific quantity of an underlying asset at a later date at a fixed price. Two parties agree to exchange a specific quantity of an underlying asset at an agreed upon price at a later date. So this is exactly the same. The only difference is there are two broad differences. Number one, this is a customized contract. Your forward contract is a customized contract, and your futures contract is a standardized contract. Point number one. Point number two, your forward contract is over the counter, right? The two parties, they do it among themselves directly, whereas a futures contract is traded through a futures exchange, and there is a daily settlement of gains and losses. So there is no futures exchange here. This is a private contract between two parties, and therefore there is credit default risk between them. Next, let's talk about swaps. Now, swaps is also a firm commitment, right? There is no right here. There is an obligation for both parties, just like there is for forwards and futures. And what's happening over here is that one party pays a variable rate and the other party pays a fixed rate. And this is something we have talked about in detail. And the variable rate is based on the market reference rate, whereas the fixed rate is based on the underlying asset or rate, which could be the fixed interest rate, and the market reference rate could be the LIBOR or whatever is the reference rate. Options, we talked about both types of options. There is a call option and a put option. A call option gives the buyer the right to buy, whereas the put option gives the buyer the right to sell. However, for the seller, it is an obligation for both. There is no right for the seller. So, for example, if I am buying a call option, I am the buyer of the call option, or I am long the call option, I have a right to buy. But if the party that has sold me this call option, which is short this call option, they don't have a right. They have an obligation to sell. If I want to buy at that price, they have to sell, right? Okay, next is credit derivatives, which we have just discussed in this video. And it is a derivative where the underlying asset is the credit between two parties. You are having a deal about the credit of another borrower, right? And I gave you the example of Emaar and Abu Dhabi Investment Authority and Emirates NBD Bank, where there is a protection buyer, a protection seller, and one is providing loss protection against the other. Then we talked about calculation of the profit and payoff for contingent claims versus forward commitments versus contingent claims, and we said that max of whatever is zero, or the difference between the spot price and the exercise price for a call option, right? This is the payoff, and after you adjust from this payoff the call premium, then you get the profit. Similarly, if you look at the other side of the situation, it is going to be just the same thing, but it will be negative, right? Because this is for the seller, whereas this is for the buyer. And here the seller is receiving the premium, so you are adding it instead of subtracting it. So that is for the call option. Now if we look at the put option, the put option obviously gives you the right to sell, which means you will make money if it goes down, because you can sell at a higher price and buy in the market for a lower price. So if the exercise price is higher than the market price, you will make a profit, right? And if the exercise price is higher than the market price, you will make a profit, but you have to subtract the premium that you have paid to calculate your net profit, right? And the opposite situation will be there for the seller of this put option, because if the exercise price is higher than the market price, then they will be obligated to buy at this price, because they have given the right to sell to somebody at this price. So there, the higher the exercise price from the spot price, the more loss they will have. But however, they receive a premium when they sell this right, so you adjust that from it. How do we contrast firm commitments with contingent claims? So firm commitments are contracts that are entered into one point and require both parties to engage the transaction at a later time, which is their expiration, right? And you agree the terms upon the start, and examples are forwards, futures, and swaps. Whereas contingent claims, there is no obligation for both parties, but for one of the parties it is a right, and for the other party it is an obligation. So for the buyer of the contingent claim or the holder of the contingent claim, it is a right and not an obligation to make the final payment contingent on the performance of the underlying. So if it's a call option and the stock price goes up, then they will buy and make the payment. If it will not go up, they will not buy, but their premium will be lost. And examples include options and credit derivatives.